This chart tracks the valuation of WeWork over a decade. It maps an aggressive climb to $47 billion in 2019, followed by a vertical drop to zero in November of 2023, when the company filed for Chapter 11 bankruptcy. When that crash happened, retail investors were wiped out, and thousands of employees lost their jobs and their equity. But the man who orchestrated the collapse, founder Adam Neumann, walked away a billionaire. In early 2024, Neumann leveraged his personal wealth to make an official $500 million bid to buy back the exact same company he had just driven into insolvency. In a typical corporate collapse, the founder's fortune is tied to the firm's survival. Here, that relationship was severed. As the company's valuation approached zero, the founder's personal wealth reached its peak. To secure multi-billion-dollar investments, WeWork presented itself as a high-margin, world-changing technology company. In reality, it was a traditional commercial real estate middleman, leasing office space and then subletting desks to tenants at a thin margin. That pitch convinced Masayoshi Son, head of the SoftBank Vision Fund. SoftBank bought the narrative completely, pouring over $10 billion into Neumann's operation. This diagram shows the structural flaw in that operation. WeWork locked itself into massive, rigid 15-year commercial lease liabilities. To pay those fixed debts, they relied entirely on fluctuating month-to-month rent from freelancers and startups. With fixed, long-term debt far exceeding unreliable short-term income, opening a new location mathematically guaranteed an increase in cash burn. The $47 billion valuation was an economic fiction. That fiction was sustained by private venture capital until August 2019. To raise more money, WeWork filed an S-1 registration statement to go public, forcing them to open their books to the scrutiny of public markets for the first time. Analysts dissecting the S-1 found the heavy financial losses, but they also uncovered a specific corporate mechanism that allowed Neumann to run the company without interference: dual-class shares. Normal institutional investors received Class A stock with 1 vote per share. Neumann granted himself Class B and C shares, carrying 20 votes each. That 20-to-1 ratio meant Neumann possessed absolute voting control. He was effectively insulated from board oversight, operating as a corporate dictator. The bylaws even contained a succession clause dictating that if Neumann died or was permanently disabled, his wife, Rebecca, held the unilateral power to bypass the board and select the next CEO. WeWork operated as a family enterprise funded by billions in venture capital. Without a board capable of checking his power, the chief executive possessed the legal authority to use company resources for his own benefit. Neumann systematically routed investor cash into his personal accounts. He purchased commercial real estate buildings himself and then leased those exact properties back to WeWork, profiting directly from his own company's capital outlays. He also utilized intellectual property arbitrage. Neumann personally registered the trademark for the word "we" through a private entity he controlled, and then sold the rights back to WeWork for $5.9 million. The corporate treasury acted as a personal credit facility. Neumann took low-interest loans from the company and directed WeWork to purchase a $63 million Gulfstream corporate jet for his travel. While Neumann extracted these massive sums to build his private wealth, WeWork's structural deficits were accelerating, culminating in a $1.9 billion operating loss in 2018 alone. The losses and the personal payouts were not a contradiction. Because Neumann had engineered a corporate structure that eliminated oversight, the business functioned as a mechanism designed to move capital from investors to the founder, regardless of whether the business actually worked. When public markets read the S-1 disclosures, institutional investors rejected the IPO. The valuation collapsed from $47 billion to under $10 billion in a matter of weeks. WeWork faced an imminent liquidity crisis, including a potential default on a $702 million bond. SoftBank had to intervene to save their investment by removing the CEO. But because of the 20-to-1 voting rights, Neumann could not be legally fired. This forced a hostage negotiation. To convince Neumann to surrender his supervoting rights and step down, SoftBank agreed to an initial $1.7 billion exit package, later renegotiated to hundreds of millions in cash and stock. Meanwhile, the company laid off 2,400 employees to cut costs. The supervoting structure functioned as a legal ransom mechanism. It forced investors to pay the founder a fortune simply to stop him from destroying the rest of his company. Without the venture capital subsidies, the math finally caught up. Crushed by over $13 billion in long-term lease liabilities, WeWork officially filed for Chapter 11 bankruptcy protection in November 2023. A year prior to that bankruptcy, Neumann launched a new multifamily residential real estate venture called Flow. Using the same playbook, he raised $350 million from venture capital firm Andreessen Horowitz. Curious, backed by this new venture capital, Flow submitted that $500 million bid in early 2024. Neumann's legal team even stated they were prepared to outbid any rival offers by 10%, attempting to reacquire the restructured WeWork assets for a fraction of their peak valuation. When hype outpaces mathematical reality, the employees and retail investors become the bag holders. Meanwhile, founders exploit corporate governance loopholes to walk away with more wealth than when they started.